Thank you for joining today's webinar on Ensuring Funding for Public Pensions, a guide to raising revenues and closing tax loopholes. My name is Hank Kim, and I'm the Executive Director for the National Conference on Public Employee Retirement Systems. Today's program is part of our Center for Online Learning, which provides remote, continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. In today's webinar, we will provide an overview and practical steps you can take to address revenues in your jurisdiction. Leading us in today's webinar are Susan Kennedy and Dr. Richard Sims. We encourage audience participation. Please submit questions by using the GoToMeetings portal. However, to ensure that we cover all our topics today, we will hold your questions till the very last part of the program. Susan, Richard, I'll turn over the webinar to you.
Thank you, Hank. I appreciate that. I'm going to start with my presentation on closing loopholes, subsidy accountability, and public pension funding. I use this presentation to basically engage pension advocates and pension trustees to give them practical tools to work around the issues of revenue and additional raising taxes or closing loopholes to further supplement the funding in their pension. So why should pension advocates care about revenues and tax policy? Basically, at every level of government, all budgets are based on current revenue estimates and tax policy decisions. So those levels of government are making the decisions with regard to where revenue goes and what gets funded. Local employee boards are making those decisions based on local revenue and deciding about local pension budgets and salaries for their employees. Legislatures are deciding those same issues in state budgets for pension contributions for employees and the state's contribution and also state minimum salaries that will build the retirement benefit in the future. Governors are also proposing and passing state budgets that make pensions a priority or not, depending on how involved pension advocates are in that process. So pension advocates should demand to be involved in revenue and tax policy decisions, not just on the other end after those decisions have been made and you're just getting the funding that's been predetermined. Pension advocates can be partners for additional investment in pensions with those government policymakers. Pension advocates can be an ally in supporting tough tax policy changes that create new funding streams for pensions. A lot of times, government policymakers will want to make those hard decisions, but don't necessarily feel supported in those. And so pension advocates and members of the pensions, including unions and associations, can be a big part of pushing those policymakers to invest in our pensions. Insist on participating in the revenue and tax policy stage of budgeting. What are the threats to stable and adequate funding streams for pensions? There are many, but I'm going to go over just a few. Tax cuts or incentive legislation. We've seen budgets be healthier in the last 5 years, and there's always a temptation with healthy budgets and larger revenue streams for policymakers to want to implement tax cuts. You know, we saw that at the federal level, and, you know, a lot of states are also considering those measures. So, you know, keep an ear to the ground about tax cuts. Also, incentive legislation, it's just a more narrowed or targeted tax cut, and it's given to certain industries. So you can, it's the same thing as a tax cut. It's just directed to some of industry, not all of industry. Subsidies and economic development initiatives. Those are similar to incentive legislation, but they can be done through the governor's office itself. They can be direct grants out of budgets, not necessarily tax cuts or tax exemptions. Tax structures that are overly reliant on volatile or unpredictable taxes. Alabama, which is where I'm from, I know a lot about the Alabama tax system, and we are almost exclusively reliant on sales tax and income tax, which makes our budgets extremely volatile. So one year, you know, if we're having a great economic year and people are buying things and they feel confident in the economy and they all have jobs, and they're doing great, then, we have a lot of revenue in our budget. In years in recession, we don't, and it's sort of a boom or bust in a crash situation. So property taxes are very important to stabilize tax structures because they provide a more even-keeled tax structure. Lack of or overfunding rainy day funds and savings accounts. This bullet used to just say lack of rainy day or savings accounts, but now what we've noticed over the last several years during the times when budgets grew is that people and policymakers were very, nervous about the 2008 crash and didn't want any kind of repeat in trying to budget through that very difficult time. So in some states, they've actually overfunded their rainy day and savings accounts, and that's actually keeping money out of the budget and out of the ability to stabilize our pensions and invest in our pensions. So if you have a savings account in your state or a rainy day fund in your state that's over about 7%, that's probably overfunded. We had large swings in the 2008 year in budgets, but that was sort of a once in a generation type of crash. We haven't experienced anything like that since Black Friday in 29. So you really should not have rainy day accounts that anticipate for the absolute catastrophic disaster, because that keeps money out of needed places like pensions and investing in our pensions. Pension advocates should bring accountability to economic development. That may sound like a big job, but it's really pretty simple. Common sense questions that can be asked during the economic development process or when a subsidy has been announced in the news. Ask policymakers to do some simple evaluation of every subsidy or economic development deal before it's approved. Is the deal good for the taxpayer? That's pretty simple and a pretty logical question, and I bet some of you know some news reporters that would be happy to ask that question. Is the return on investment for the subsidy larger than the return on investment in pension funding or education? And we'll talk about what the return on investment is in a pension funding or education scenario, but we want to make sure that the subsidy is actually going to return investment to the state, because obviously the taxpayer's money is valuable and you want it invested in things that return. What taxes are currently being paid by this particular economic sector? Do they compare favorably with surrounding states? So if it's a call center, a data call center, those are kind of all over the place. If it's retail, Walmart or a Target is going to come to your city. It may choose between one city and another, but retail has got to be where the people are. So you may not need to be incentivizing retail to come to your area. If it's a populated area, they're going to come anyway. And if it's not populated, they're not coming no matter what you offer them. If it's mining, they have to go where the valuable resource is. So if it's coal, you shouldn't be incentivizing the oil and gas industry necessarily, because they have to go where the oil and gas is. So some common sense ideas about what is this economic sector, and is it necessary to actually win or keep this business? So comparing them favorably with other states is also an issue. Alabama is 51st, I think, in overall tax burden. So, if they come to Alabama, it's not because they are, they're coming for if they're choosing between Alabama and another state, we're always going to win on the tax side. So just watch out for, if the industry is treated extremely well in your state versus other states, you may not need to incentivize that industry at all. And finally, if so, how can we pay for it by eliminating another subsidy or loophole that's not effective? So the film credits are one of the major incentives that have been passed over the last 10 to 15 years. Those have been proven over and over and over again not to be a good investment. So that's basically just a subsidy. They're just writing the industry a check, and they're not getting a return on that investment. And that's been proven over and over in a lot of different studies on the film tax credits. So if you have film tax credits and there is a subsidy that you feel like has momentum and is going to pass or go through, then you can ask policymakers to end one that is not effective. Investment in public pensions is an economic development initiative. I think it's important that pension advocates begin to learn to talk about pension investment as an economic opportunity. When we cut back our investment in public pensions, everyone suffers. These are simple tenets, but I think when we begin to talk to policymakers in these contexts, we change the conversation from someone who is just demanding additional revenue to someone who is asking for a legitimate investment in something that's going to grow the economy of the state. Pension benefits and the economy go hand in hand. Benefit payments are an economic driver. We know that. Cutbacks in pensions decrease economic opportunity for all. And finally, pension cuts increase social costs, higher poverty, medical costs, crime, disorganization. We're really taking care of the elderly in our communities with pensions. If those pensions were not sufficient or adequate to take care of the elderly folks in our community, then the state's got to pick up that tab. So pensions are actually the best mechanism to provide that safety net for our older folks. Let's talk about the economics of public pensions. If you're going to talk to policymakers about investing in pensions, then you need a few tools in your pocket about the economics of public pensions and why that's important. In 2016, spending in pension benefits generated $1.2 trillion in total economic output, supporting 7.5 million jobs across the United States. This spending resulted in billions in federal, state, and local tax revenue. At the state level, public pensions have the same strong economic impact they do at the national level. California saw nearly 500,000 jobs supported by public pensions, spending more than $73 billion in economic output attributable to pensions. Texas has the largest pension expenditure multiplier with $1.83 or 1.83. This means that for every dollar paid out in a pension benefit in Texas, $1.83 in economic activity results. That's a pretty good return. That's almost 2 to 1. Those statistics you can find in the National Institute on Retirement Security Pensionomics from January of 2019. So if you want a few facts in your pocket, there are some good ones. Here's a few more. Why are we investing in public pensions? It can be a political winner and it grows the economy. Recruiting law enforcement, recruiting quality state employees, and recruiting teachers is a big thing these days. And so, you might be able to turn this into a political winner by providing ways to increase revenue and investment in pensions and grow the economy at the same time. Policymakers like those two things together. Money invested in public pensions stays local and further drives the economy. So when you get your pension check here in Alabama, you go and you spend it you get a haircut. You might get your nails done, at least I do. Or you go to the grocery store in your town, or you buy, something at the hardware store. But that money is staying in that community, and it's a lot of it is subject to sales taxes, and a lot of it, of course, is subject to some types of income tax. So that money is going to be local. When you create a subsidy for a giant corporation and give that corporation that subsidy, it may go back to their headquarters state. We really don't know where that money goes. But when you invest in pensions and pay pension benefits, that money stays in the local economy. The economy grows by $1,088 with the investment of each $1,000 in pension fund assets. So that's a decent return in the economy, over a 100% return of pension fund assets. Pension funds are revenue generators. This is a good one. I like this one. The 2016 pension funds generated approximately $277 billion in state and local revenues. So those are tax revenues that are coming back to your state and your local community. The taxpayer contribution for that same amount was $140 billion. So the taxpayer's paying in, but they're also getting money back out. Why invest in public pensions? Oh, I had to do that. Sorry. Hang on one second. I think I got ahead of myself. Well, let's talk about where those facts came from at the end. See, this is an NCPERS publication, Unintended Consequences, from May of 2018. So those are really good facts as well, and you can have those. When you talk to policymakers. So another piece of information I always recommend that people get, or they get some statistical information about the corporate tax in their state. So the corporate tax is an important piece in the puzzle to a complete revenue picture. The corporate tax has generally not been something that folks pay a lot of attention to. It's not a huge producer in terms of revenue, but it is an important piece, because just as individuals are going to work and paying their taxes, it's important that we have a system that also makes corporations pay their fair share as well. So if corporations are using our resources like the police and the fire and driving on our roads and sending some of their kids to our schools, we need to be able to say that they're participating in the revenue system. And so these questions are designed to find out the health of your individual state's corporate tax scheme. So the first thing that you can do is ask companies that reported over $50 million in total income to the IRS, how many of those companies paid zero corporate income tax for the 4 most recent complete tax years? So that question, you can just take that question verbatim and give it to either your legislative fiscal office or the revenue department, or sometimes the finance department in your state will have that information. And you're not asking for corporation names or any data that they're not allowed to disclose from the revenue department. You're just asking for statistics. And you can ask that same question for companies that reported over 100 million, over 250 million, or over $1 billion. And when I first started asking this question to state revenue departments, I didn't ask the $1 billion question. And then one year I was like, well, let me just see if somebody's reported $1 billion in income to the IRS and then still paid no tax in the state. Because in your mind, you think, well, the more you make, the more likely it is that you have to pay tax, or that you actually have to pay more tax. If you make more money, then you have to pay more taxes. That's sure how it works for people. But in fact, it doesn't work that way for corporations. So if you want to ask over 10 billion, ask that question to see if there's actually any company that made over $10 billion in your state or reported that much to the IRS and didn't pay any taxes in your state. And then the second question I like to ask is, of the state's 150 largest for-profit employers, how many paid zero corporate income tax for the 4 most recent complete tax years? And we'll see some results of this in just a second. So that question's pretty simple. It's like, let's look at the 150 biggest operating companies in our state that actually have people employed here. So it's not just a fake headquarters or a place where 2 accountants work and it's not really an office. Let's talk about, people that actually have boots on the ground and people working in the state. And of those 150 companies, who paid any tax? So Louisiana is one that we looked at pretty recently. So of the largest 150 corporations by payroll in Louisiana, only 51 paid any tax at all. So there were 99 of those same 150 companies that paid nothing. That's a pretty big number for people paying actually zero tax, not $10, not $20, but zero. So 99 of those companies paid nothing. And then you want to know, from that you can get some additional information, dig a little deeper, and find out if big business is actually paying a fair share in your state. So in 2010, over 2,200 companies doing business in Louisiana made more than $815 billion in federal taxable income. That's profit. That's not just income. That's the taxable income, which means that's after all the deductions. And they did not pay 1 cent in Louisiana corporate income tax. Those companies made $8.4 billion inside the state of Louisiana, meaning income that's directly related to the state of Louisiana. If that income was taxed at their corporate rate, which is 6%, it would have produced an additional $500 million in revenue for Louisiana. So you could do some pretty good investing in pensions with that additional revenue. In 2010, of the over 100,000 corporations in Louisiana, 91,000 or 83% paid no income tax. And that is not because they're not making money. It's because they have loopholes in their corporate tax that allow companies to avoid taxation. Let's look at one more state. We'll look at my state, just so you feel better, because I'm working on it, but I haven't solved it. In 2013, 2,800 companies doing business in Alabama made more than, excuse me, this is PowerPoint. Won't let me see that. Hang on. Sorry. In 2013, 2,800 companies in Alabama made more than $583 billion in federal taxable income and did not pay 1 penny in Alabama corporate income tax. If those companies had made just 1% of that income in Alabama, or $5.83 billion, and that income was taxed at 6.5%, which is Alabama's corporate income tax rate, it would have produced almost $379 million in additional revenue. Now, that is a lot of money anywhere, but it's really a lot of money in Alabama. In 2013, of the almost 60,000 corporations doing business in Alabama, 23,000 of them, or 67%, paid no income tax. So that kind of gives you an idea that our corporate income taxes in the two states that we looked at, we've looked at more states, and they basically mirror these same results. Our corporate income taxes across the country are not very healthy. They're not really producing the kind of revenue that they need to produce as part of the puzzle and the picture of a full and complete revenue system. So how are they doing that? I know my father is an entrepreneur and has had a small business for a really long time, and he's never figured out how not to pay taxes. So I wondered, how in the world are these corporations able to make billions of dollars and pay no state income tax? Well, there are a lot of ways that they do it, and I'm just going to go over one today, one simple one, because there are a lot of them, and a lot of them are a lot more complex. But we'll go over one simple one that I know that companies use to avoid state income tax. It's called the Advent Gimmick, shifting income to other states with no taxes, or no corporate tax. So if you'll look here in the Louisiana Corporation on the right-hand side of this circle, that could be a retail organization like Target. It could also be a Walmart. It could be a lot of retail organizations use this particular loophole. So I know that Target uses it, and I know that Walmart uses it. So let's just pretend that Louisiana Corporation is your local Target. So that local Target makes profit that day, and they send that profit to the Delaware PIC company. Now, a PIC company is a passive investment corporation. So that Delaware company is also a Target company. It's also the Target organization. And that company owns the Target logo and then I guess what you'd call the intangible property of a corporation. It's trademarks and copyright. So that Target that you see on the side of the building, that Delaware passive investment company owns the right to that Target, that actual bullseye. So the local Target pays their sister corporation, that Delaware passive investment company, a fee for the use of that bullseye on the side of the building. That fee is normally the amount of profit that they make in a month. So they'll pay by the month. If they made $1 million in January, then they owe $1 million to their sister corporation for the use of that Target bullseye on the side of the building. There is no corporate income tax in Delaware. So that payment for that trademark is a deduction for the local Target, and it's not income to the Delaware passive investment company because there is no income tax in Delaware. So they don't pay tax in Louisiana because it's a deduction for the target. They don't pay income tax in Delaware because there isn't an income tax in Delaware. Then they can send it out to their West Coast parent or their parent in New York. And that parent, it's a dividend from a related corporation because it's a payment from the Delaware company to its related parent. And so that dividend is not taxed because there's another little wrinkle in the tax code that says if you get a dividend from a related company, somebody that's the same as you, it's not income to you because it's just moving money around in the same account. So if it's all going to the same place eventually, you don't have to pay tax on it. So they have a loophole so it doesn't get taxed at the West Coast parent because it was a dividend that was received from a related company. And then they'll pay that dividend right back to the Louisiana corporation because they can pay a dividend to a related corporation and not be taxed for it at the Louisiana level because it's a dividend from a related corporation. So this big circle, and I hope I've explained it well. If not, y'all can ask me questions at the end. But you can see these arrows going from the Louisiana target to the Delaware passive investment company, out to the West Coast parent, and then back to the local target. And all of that money is the profit from the local target that just got washed in this big circle. And now it's all the way back to the local target. It really never left because it's just entries on an account in the accounting note. And now when it started out as profit in the beginning, when it came back to the Louisiana corporation, oftentimes in the same day, it's something else. It's not profit. So they've transformed income into a dividend from a related company, and that's not taxable. So after all that, it's just they can do that with an enormous amount of profit and just hide and shift income to no tax states like Delaware, and other little wrinkles like dividends from related companies, and it comes back as an untaxed. So that's just one of them. But a lot of them are similar. You can do that with your rent. You can rent to yourself. You can pay for consulting services to yourself. A lot of related company transactions are a big way that corporations can avoid income tax. And obviously my family who has one little small business doesn't have a lot of related companies. They are the only thing. So small business really takes it on the chin in terms of being able to do these kinds of these kinds of structures that allow taxes to be avoided. So a lot of people do this. Like I said, a lot of people don't pay any taxes. A lot of really large corporations that make a lot of money don't pay any taxes. Here are some. ITEP is the Institute for Taxation and Economic Policy. They put out a report of the largest the largest companies that are avoiding taxes and paying no taxes. And so that's where these came from, but they update that every so often. And so you can just check and see. They'll give you the names of the companies that are actually paying zero taxes to any state. And what is the ask in your state or community? Why do you want to burden yourself with learning all this and getting involved and trying to figure out, things about subsidies and trying to talk about pensions in economic ways? You can begin to lead in these areas in funding for stable pensions, salary increases and benefits, which ultimately result in richer benefits, reliable COLAs, recruiting and retaining quality professionals. That's a big thing right now. And then, in general, we need to keep our promises to our seniors and bring dignity to people's retirement. And, that's why I get involved. That's why I like to do this work. It may seem nerdy, but in the end, when you confront policymakers with the idea that there are huge corporations operating in our state and they're not paying their fair share, most of the time you can get some momentum to at least have conversations about stable funding for pensions. And I'll be happy to answer any questions at the end.
Great. Thank you, Susan. So again, just echoing Susan's points. We do encourage audience participation, so please submit your questions via the GoToMeetings portal. And now we'll turn it over to Richard Sims, who will talk about state tax revenue trends and implications for public pension funding, including 9 guidelines for sustainable tax revenues. Also, in the handout section of the GoToMeetings portal, you will see the PDF of the report that both Susan and Richard are talking off of, which is ensuring funding for public pensions. That will be mailed out to all of our members this week, but you do get a PDF preview from this webinar. So with that, let me turn it over to Richard Sims.
Thanks, Hank, and thank you very much, Susan, for the presentation. The Great Recession that began back in January of 2007 and went through mid-2009 was a body blow for public pensions in a lot of states. The number of public employees paying into pension funds declined because states and local governments were laying off people. At the same time, states' revenues were in free fall, and the state's ability to make its contributions declined substantially. That led many policymakers around the country to start demanding that we cut back on public pensions, reduce the benefits, reduce the state's contribution. We wanted to give a quick look at some of the trends on the reality behind how bad or not bad state public pension shortfalls are, what states' capacity to fund pensions are they really in that dire strait, and looking into the future, what are the current trends, and then coming up with some guidelines for policymakers and for other people concerned about the viability of public pensions going forward to consider. As I mentioned, with the recession that kicked the legs out from under state governments, there was a monumental decline in funding, in state employment. And then after the recession was over, roughly a decade ago, since that point of mid-2009, let's say, up to current, individuals' revenues, or individuals' income around the country has gone up a little over 25%, almost 26%. But state tax collections have gone up only about 13%, about half as much. That's a problem going forward because that means states aren't able to keep up with their obligations under the current system that they have. We want to explore some on why that's the case and to see what can be done about that. If you go back to roughly the late 1950s forward and look at total state revenues as a percentage of personal income of those states' residents, there was a slight upward trend all through the years up to roughly 2000. Each year, states would have a little more revenue to spend that enabled them to stay up with their obligations and occasionally expand. States were taking on new roles at that time. During the 70s, a lot of federal responsibilities had been shifted down to the states. The feds supported somewhat through block grants that were targeted to help states achieve some of these goals, but they also required matching funds from the state's standpoint. So states were needing to come up with new funding sources. There was increasing demands for the major state expenditures, public education, for higher education, for streets and roads. All of these were putting demands on states, and at the same time, states' tax systems were overall, for most states, growing. And I'm speaking in broad collective terms right now because since you have a universe of 50 states, there's no two states that are just like, a lot of variance within the states, and we'll discuss that briefly in a moment. But as the states started to recover economically, meaning within their own personal income in the states, we saw that the revenue system didn't keep up at all. Wondering what was the source of this lack of growth. We looked at the year-to-year growth rates since 1970 forward, and that growth rate averaged about 6% a year on average. Since the recession that again ended in 2009, since that point, in every year except one, growth of state revenues has been below the average for the entire period before that. And that one year was all because one large state, whose initials are California, passed a massive tax increase that brought the average for all states up slightly above the long-term trend average. Other than for that, we've been below average growth for the last decade. That's in total tax collections. If we look at the major sources, states get most of their revenue from the income taxes from individuals and corporations and from sales taxes. Those two taxes account for the vast majority of taxes in most states, running up to 90% in those two broad categories for most states. The individual income tax grew steadily every year from 1970 up until the recession. Each year you'd get collections growing faster than personal income. Since that time, it's been flat. There's been no growth in the individual income tax that accounts for around a third of the average state's revenue collections. The general sales tax, another big category, also accounting for somewhere between a third and 40% for most states, grew substantially from 1970 up until the mid-90s, and then has been declining substantially since that time. Again, when I say decline, it's in terms of the personal income of the state's residents. And finally, the corporate income tax has been on a downhill slide since the mid or late 70s. It's been going each year as a percent of the economy and as a percent of state's revenue collections. The corporate tax, incidentally, which today represents somewhere around 2% of the average state's revenue collections, has fallen by about 50% as a share of the state's revenue over the last 3 decades. So it's going down and getting smaller and smaller. There'll be further declines going forward because the feds are reducing their tax base for corporations, and most states simply adopt the federal standards on that. So when the feds make a change, it's automatically reflected in state government collections. So state corporate income taxes have diminished tremendously, largely because of the things that Susan was talking about, broadly defined loopholes, exemptions, things that states have done to themselves in the way of passing along special treatment of corporations that if they had paid the regular rate they were obligated to pay, we would have had tremendously more revenue than we have now. In a number of states we've looked at, the amount that states give away, if I can use that term, in tax breaks and loopholes is as in some cases greater than total amount of revenues that they actually end up collecting. So that's been a long-term trend, and currently I don't see a reversal on that unless policymakers take action to do some of the things that Susan had just indicated as far as reversing some of these decisions to close wasted loopholes and inefficient expenditures of grants to business. Going back to the individual income tax, the reason that we've determined that it had stopped growing was because states had decided to cut corporate income tax rates. Since the recession, 14 states have reduced their corporate income tax rate at a time when they're needing additional revenues. There's no state that has met its full needs for infrastructure repair, for example. Most states are funding public education levels below where they were prior to the recession. Higher education is being cut in many, if not the majority of states. So it's not like the states have overdone the things that they're responsible for, but still they have felt that a reason to cut the rates of individual income tax. It's often done in the names of economic growth, but the studies that we've looked at indicate that there's no correlation between cutting the individual income tax rate on upper earners and the economy. Over that same period since the turnaround about 10 years ago, states have increased their individual income tax rate steadily. 14 states, not all the same 14, I mentioned 14 states cut the individual income tax, and also 14 states increased their general sales tax. The general sales tax rate has grown from about 3.7% in the 70s to about 6% average around the country now. The problem is many states are dropping into rates as high as 10%. And in many large urban areas, they have a combined state and local rate that'll hit 10 and sometimes 12, and in these cases, 14%. That's seen by most analysts as something of a ceiling. Once you get as high as a 10% sales tax rate, the public resistance to going any higher is just overwhelming. People are very angry about paying 10 cents on every dollar that they spend on consumer items. So the ability of the sales tax to grow in the future needs to be limited by the high rates most of the major urban areas at least are already hitting at, and many of the states around the country are saying the same thing. They haven't been able to pass new sales tax increases because of these extreme upper levels. So those two funding sources seem constrained going forward, and the corporate income taxes certainly have declined because corporations have been very good at making the case on why they should receive a tax break, even though, as Susan indicated, in many cases it's doesn't do what it was designed to do. We sat in the court several studies that looked at what happens when states have passed corporate tax breaks and exemptions and other subsidies to attract business, addressing the question of does it create jobs and income. And studies by several academics and the Brookings Institute and even the Congressional Budget Office have looked at this and found that there's essentially no connection between tax subsidies and exemptions and tax breaks and growth in the general economy. And in fact, some of the tend to accrue to outside owners and employees outside the taxing region rather than local employment. What several of the studies have recommended is that the state would be much better off from a job standpoint, invested in itself in spending in things like supporting public pensions, supporting education, supporting programs in streets and roads and things within the state. So those, echoing Susan again, those are things that we should look at most carefully, are doing a better job of looking after our taxes. I'm going to go quickly, given the time, to the guidelines that we determined would be beneficial for policymakers and for advocates for public pensions, as well as for all other public services, because we're all focused on making sure we have adequate revenue for public services generally. And the first item to come up is simply to keep what you have. It's much easier to keep revenue than it is to gain it. So when people come along every session and argue for tax breaks for some purpose. It would be a grand idea to simply resist cutting taxes until taking care of all the needs that you already have, until you've closed any pension funding gaps, until you've met your educational needs, until you've fixed your infrastructure. So keep what you have is the first guiding principle. Be very skeptical of incentives and tax breaks. This is what Susan was talking about, that each tax break needs to be reviewed very carefully to make sure it's going to do what it said to do. There should be a measuring criteria put in place to make sure that the taxpayer was getting their return on their investment. These are all things that tax analysts know how to do, but policymakers often don't work on the answer. Another tactic or guideline principle that often works is to simply reverse previous tax cuts. If you were needing $100 billion for some program in Ohio or New Jersey or California, go back into your books and see what taxes you had cut in the last few years and reverse that, because it's you had it in place, so it's something taxpayers are familiar with. When it was taken away, it was probably done for a specific reason that might not stand close scrutiny. So look at reversing any previous tax cuts. Fourth guideline was to increase reliance on the personal income tax. I mentioned it briefly before, but when I used to be a state tax analyst, we would notice year after year that the only tax that grew in terms of producing revenue faster than the economy was the individual income tax. That's because most individual income tax structures are progressive, so they have a higher rate as it goes up, and as more people rise into these higher brackets, it rises. In addition, over the last, now going on to 25 years, the growth in most state individual income, the base of the income tax, has been concentrated among the upper income earners, those who would fit that highest rate category. It's not unusual to see your top earners earning around 20% or more of the total income in the state. So any tax that relies more on people's income, grows faster, and also have more to begin with, is going to put the state in better shape, as well as having a more even total structure. We didn't talk about it in this report, but the income tax, the individual income tax, is the only tax that taxes upper income individuals at least as high a rate as it does low income individuals. Taxes like sales taxes and cigarette taxes and so forth fall most heavily on low income individuals. And out of all the taxes they have in their portfolio of taxes, the only one that falls most on upper income individuals are the income taxes, and the only tax that grows or has potential to grow as fast as growth in the economy is the individual income tax.
Hey, Richard, this is Hank. I'm going to ask for sort of a wrap up in 2 to 3 minutes.
Good. Okay. By relying more on the individual income tax, you rely less on sales taxes and consumption taxes. Avoid swaps where states swap income taxes for sales taxes. That's always harmful to lower income households, and it diminishes long-term revenue. Be very careful of exotic revenue sources. Things like cannabis taxes, lotteries, all of these taxes tend to be, they get a surge of income in year one, but by year 3, they're being existence. They diminished substantially and are not reliable for long-term revenue sources. Be very careful of reviewing all of the what are called tax expenditures, the breaks and exemptions in state tax law. Many states have commissions that review these on an annual or biennial basis. Those are very productive for making sure that any exemptions or breaks you give work. And finally, sunset all tax breaks. That means that you put a time limit for any tax break on how long it's to remain in effect. After the time is up, the people that benefit from it have to come back before the General Assembly, reapply, and if they have to make a good case for its continuance. Otherwise, these breaks go on into infinity. And with that, I'll be glad to answer any questions that might arise.
Great. Thank you, Richard. Thank you, Susan. So, as you know, changing taxes at any level, whether it's local, state, or federal, is pretty hard. What practical advice do you have in terms of how, public pension advocates or those who just want more fair and representative and progressive tax systems to be implemented? Should they give themselves a year runway, 2-year runway, 3-year runway? What are some of your thoughts about how people should begin and what sort of time frame they should allow for themselves?
State policymakers pay acute attention to the voters in their area. So if you're concerned about things like funding public pensions, you should start organizing local voices to come up to insist on some of these guidelines that we've indicated, bringing up some of the facts and evidence that Susan and I have put out there, to talk to local groups and clubs and so forth, who will then turn to the legislators to make sure they are tuned to some of these guidelines and issues we've discussed, so that they can't say, well, we don't have the money to do the right thing by pensions or other public services. And you can say, here are in fact some of the things you can do. Here's where the money can come from. It's not like we're tied to the current revenue structure we have. Here are ways to use our current revenue structure to generate more revenue, but it needs to be done at the grassroots level. You can't count on legislators to, on their own, simply start doing the right thing. They will do what their constituents demand of them. So it has to be done at the grassroots level.
I think that's right. Richard's right. And what I try to do is I look for a champion. Some of you signed on in this webinar today because the subject matter interested you. Some of you might have signed on because you're a pension advocate and, you want to get more proficient at your advocacy. Richard, I think you probably need to mute. I'm getting a ton of feedback. So what I would do is I would try to find a champion. The people on this call were interested in this subject matter, and you might be surprised there will be some policymakers that are also interested in this subject matter. So I think Hank's right. A year timetable is probably prudent. It's not a commitment that you can accomplish in a couple months. So we need to be realistic about that. But as you begin to educate a champion, whether that is, some of the staff of the pension board or some of your fellow folks that serve on the pension board, or whether that's a legislator or someone in a governor's office, or even someone at the revenue department or someone that's an advocate for additional funding. These are the kinds of things, this toolkit and, some of these gathering this information that you can gather from this toolkit. When you disseminate that to certain people, you can find some champions. And so you just need to build your army. And that may, here in Alabama, it doesn't take that many. There are probably 10 to 15 people that work on, raising objections to subsidies and loopholes. And it's been a very successful crew. They educated themselves and they are just always on point to, appear at any hearing or any budget issue that has to do with subsidies or incentive legislation or tax cuts. Also, you can look to your local, the Center for Budget and Policy Priorities has a local sort of a partner in every state. In Alabama, it's Alabama Arise, but it will be like the state budget folks that are sort of the nonprofit folks in your state. and they're usually very educated on the issue. And so I try to partner with people like that and give myself about a year on any particular issue just to become the people that are, looked to as the folks with the information.
Great. Thank you, Susan. Thank you, Richard. And thank you all for tuning in to Ensuring Funding for Public Pensions. I think you'll agree that this was a very informative webinar. And again, the printed version of this report will be mailed out this week. You can download the PDF version either from the portal or from our website. And our next webcast, our semi-annual legislative webcast, will be held on January 14th at 1 p.m. Eastern. Thank you so much and take care.